Okay, let's take yesterday's discussion ahead with three small questions and a couple of concepts that need to be revised. Okay, now this question doesn't need any specialized costing knowledge. It's just based on basic common sense. Let's have a look at the requirement. If the pizza makers are paid $4.5 per hour, what is the attainable standard labor cost of one pizza? What they have asked you is they have asked you attainable standard labor cost of one pizza. The fastest time in which a batch of 20 cheese burst pizzas has been made was 32 minutes. 20 pizzas, 32 minutes with no hold up. Matlab, the machinery was working properly. There was no breakdown. So nothing was stopping you from achieving the number of 32. However, work studies have shown that on an average, about 8% of the pizza workers' time is non-productive time, and that is in addition to this, and that in addition to this setup time, that is getting the ingredients together, is 2%. Is 2 minutes. If the pizza makers are paid 4.5 per hour, what is the attainable standard cost? What so there is this second line which says that about 8% of the pizza maker's time is non-productive time. What do you mean by that? When 8% of the time is non-productive, they are doing gossip, they are doing time pass. That means the remaining 92% of the time is productive. If 8% of the time is non-productive, then that means 92% of the time is productive. Okay, now the data say, what does the data say? The data says that in 32 minutes, 20 pizzas are made without any hold up. Without any hold up means without any distraction, without any time pass. Now, the question says in 32 minutes, 20 pizzas are made. But this is without any hold-ups. That is without any wastage of time. Okay. So that means 32 minutes is the productive time. 32 minutes In 32 minutes, you can make 20 pizzas, but that is without any hold up. That is without any wastage of time. So that means 32 minutes is productive time. And how have we set up the total? How does the total equation look like? Total time, if it is 100, and non-productive time, where they are doing time pass, is 8 minutes. What is the productive time? Productive time is 92 minutes. Okay, 92 is the 92%, 92, whatever is the productive time. Here, my actual productive time is, I'll have to calculate that. Okay, so these are my assumed values, and I have to now get to my actual numbers. Okay, 32 minutes is time taken without any hold up. So I should write it here. Now what I need to arrive at is the total time taken, which will be 32 into 100 upon 8, that is 34.78. Cross multiplication, 34.78 is equal to 32 into 100 upon 92. Okay, cross multiplication, you do 32 into 100 upon 92, you arrive at the total time to be taken. Now, This is 32 is the ideal standard. Okay, 32 is ideal standard. That is assuming that everyone is working at super 100% efficiency. There is no wastage of time. 32 is that duration. 34.78 is attainable standard because when human beings work, they are going to need that time off. They are going to need that. There will be that non-productive time anyway. There is nothing you can do to change it. So this is attainable standard. How does this work? Attainable standard. Attainable standard 34.78 because after allowing for regular time pass, gossip, and all of that, the time is 34.78. 32 is my ideal time. Okay, 32 is my ideal standard. But to this now, I'm going to add what else? I'm going to add 2 more minutes. Add setup time. How much is the setup time? You need around 2 minutes for setup. So, what is the total time taken? Total time taken is 32 plus 2. Not 32, sorry. 34.78 plus 2. 36.78. Now, 36.78 is again the attainable standard time. Why is this attainable standard again? Because after factoring in the setup time, how much time will you need to set up the machine? You will need another 2 minutes. So this is your attainable standard. But this is total time taken for what? This is total time taken for 20 pizzas. So what is time taken for one pizza? 36.78 upon 20, that is 1.84. Okay. Now, if the pizza makers are making 4.5, if the pizza makers are paid 4.5 per hour, this is time taken for one pizza in minutes. है ना? This is time taken in minutes. So, how do you arrive at the total attainable standard labor cost? I will convert this into hours. Okay. When I convert this into hours, it will be 1.84 upon 60. 0.03. So, what is the cost or labor cost for one pizza? This into $4.5. So, 0.138 is the labor cost of one pizza. What I did was I multiplied 0.03 into 4.50 per. This is the calculation. ठीक है, have a look at it once. Any questions that you have, please feel free to ask me. These calculations will be used in so many other discussion points later, so it is important for you to make a note of that. Any questions, Abu, Junaid, Tushar, Ishan? Anything that you want to ask here?
No, sir. Understood.
Now, the budgeting part is a separate chapter altogether. Okay. We'll be doing a separate chapter altogether, and that is going to be a theory discussion here. What we have is we'll have a chota sa discussion on basically three concepts, that is fixed budget, flexible budget, and flexed budget. Now, tell me something. The word budget to most of us basically means, I mean, we use the word budget and forecast and plan. We use all of these words interchangeably. Budget is basically planning for the future period based on certain studied assumptions. Maybe it is your past track record that you are looking at. Maybe you are looking at the past track record along with information on, uh, finer nuances like, economic conditions, state of your company, state of competition in the market. You consider all of these things and you make a plan for the future. Such a plan is known as a budget. Now, the word fixed budget and flexible budget are two important things that you should know. Fixed budget is static. Static matlab it doesn't change. It remains the way it is throughout the year. Fixed budget is prepared before the beginning of a budget period for a single level of activity. For a single level of activity, the word single level is important. What is the significance of the word single level? What it means is, say for example, I prepare a budget assuming that I will produce 1 lakh units of a particular item in the upcoming year. Now the number is fixed at 1 lakh, and I make all my comparisons with reference to that 1 lakh only. So even if my actual number achieved was 90,000 units of output or 1 lakh 10,000 units of output, I still make all the comparisons with reference to that 1 lakh units only. So fixed budget, this is static. What does the word static mean? Something that does not change. Okay. Flexible budget is also prepared before the beginning of the period, but it is prepared for a number of levels of activity and requires the analysis of cost between fixed and variable elements. I will show you numerically how that is done. So fixed budget is for a single level of activity and flexible budget is for a number of levels of activity. Excuse me. Flexed budget. This is prepared at the beginning of the budget period. Sorry, this is prepared at the end of the budget period, and it provides a more meaningful estimate of cost and revenue and is based on the actual level of output. Flexed or flexible, people often get confused. So just remember, another word for flexed budget is adjusted fixed budget. Now, this word is not given in any book, but this is what the flexed budget actually means. This is adjusted fixed budget. Now let me show you through an illustration what this means. I assumed that I will get 1000 enrollments this year for performance management class. So I got I prepared a budget for producing and printing 1000 textbooks. I assumed that I will get 1000 enrollments this year for performance management class. So I prepared a budget for producing and printing 1000 books. So if I were to prepare my fixed budget, I would say cost of paper. I will first of all write down number of books. Number of books is 1000. ठीक है. Then cost of paper is say 80,000. Cost of printing 75,000. Cost of binding is 15,000. So, what is the total cost? 80 plus 75 plus 15, that is 1,70,000. So, this is my fixed budget. And during the year, whatever number I end up achieving, I compare that number with this number and let's see what problems are encountered there. I actually ended up printing only, uh, I actually ended up printing 1200 books because I got more admissions. Okay. Now, what was the actual cost of printing and making the books? Okay. So, number of books 1200. Uh, Cost of paper 1 lakh. Then cost of printing and cost of binding. This I could get done in 85,000 and cost of binding, maybe I could get this done in 19,000. So my total cost was how much? My total cost was 1 lakh plus 85,000 plus 19,000. That is 2 lakh 4,000. Now, as a business entity, I wanted to see whether I was within the budget or whether I was beyond the numbers that were given to me. So I wanted to check whether my spending slash expenditure was as per the amounts allowed slash set in the budget. Okay. I wanted to check whether my spending was in line. And why was I wanting to do this? Because I wanted to fix accountability. If Ishan is in charge of printing, I wanted to see whether I should scold Ishan or whether I should praise Ishan. And how is this decision driven? Whether I should scold Ishan or whether I should praise Ishan? That depends on whether he has acted according to the numbers given in the budget or not. I am doing this to fix accountability and reward or uh, scold the person in charge. Now, Ishan was in charge of printing. I checked my fixed budget, which allowed a cost of 75,000 for printing, and as per actual numbers, it was 85,000 for printing 1200 books. I looked at this number, I got annoyed with Ishan, I called him to my cabin and I blasted him. I scolded Ishan because the actual cost, 85,000, was more than the budgeted numbers, 75,000. उसका मूड ऑफ हो गया. But Is this correct? Is holding Ishan responsible and saying that you have not done a good job? Is this statement correct? That is something we need to evaluate. This budget was prepared for 1,000 books. My actual books printed were 1,200. Okay. The budget was made. The budget was made for 1,000 books, whereas the actual achieved numbers were for 1,200 books. So, comparing 75,000 versus 85,000 is an unfair comparison. This is not the correct comparison. This is an unfair comparison. Now, when will comparison be fair? When I compare 1,200 with 1,200. When will comparison be fair? When I compare 1,200 with 1,200. Okay, so if I have to do that kind of comparison, how should I go about it? So I will have to adjust my fixed budget to enable this comparison. I will have to adjust my fixed budget that was made at the start of the year. Okay, so let's do that activity. This is fixed budget, start of the year. And now I'm going to make an adjusted fixed budget at the end of the year based on actual numbers achieved. Okay. Adjusted fixed budget made at year end based on, okay, made at year end. Okay. How many books did you actually print? 1,200. Now for 1,000 books, the cost of paper is 80,000. So for 1,200 books, the cost should be 96,000. The cost of printing should be 90,000. This should be 18,000. This is the adjusted fixed budget, which is also known as the flexed budget. Okay. इसको मैं 21,000 कर देता हूँ. इसको हाँ. Now let's now write down the actual numbers achieved. Actual numbers achieved. ठीक है. 1,200. These are the actual numbers. Now, the comparison that I'm trying to make is a like for like comparison. Which are the two columns I'm trying to compare now? I'm trying to compare the adjusted fixed budget made at year end, which is based on the updated values according to 1,200 units produced. So now I can do the right kind of comparison. And now when I do a variance analysis, okay, I'm now going to compare the budgeted numbers versus the actual. This comparison makes a lot of sense because it is a like for like comparison. So in fact, I should be praising Ishan, not scolding him. I should probably give him a reward for saving cost. Why? Because as per the adjusted fixed budget, he was allowed to spend 90,000, but he only spent 85,000. I should, on the contrary, reward Ishan because for 1,200 books, he was allowed to spend how much? He was allowed to spend 90,000 but he spent only 85,000. That is a saving of 5,000. So he was allowed to spend 90, he ended up spending 85, and now this comparison, this 1200 to 1200 comparison is valid. Now, this is your static fixed budget made at the start of the year. Okay, this is budget made at the start of the year. This is called fixed budget. This is called adjusted fixed budget or flexed budget. This is fixed, this is flexed, and these are the actual numbers achieved. So flexed budget is nothing but adjusted fixed budget. Fixed budget adjusted to actual numbers achieved, that is known as your flexed budget. ठीक है, so this is a term that you have to be aware of. ये in the future at some point it might get tested. Especially na, this gets tested in the theory MCQs. And what people do is they will focus on standard costing and 10 other things, but they will end up not paying due attention to simple theoretical concepts that can fetch them a lot of marks in the exam. So ideally, these choto choto theory points that are there na, or small concepts that are there, they actually help you achieve the desired score in your exam. So make sure that you understand these concepts properly. We have looked at fixed budget and we have looked at flexed budget. We have not yet looked at a flexible budget. We'll look at that in a minute. I just want you to have a look at this once. Have a look at it, then we'll move on to the concept of flexible budgets. Yes, Abu, tell me.
So in this comparison, actually, on the total, there is a negative variance. So is it acceptable, or how can we judge the acceptability of the budget versus actuals?
So, the whole point of doing a variance analysis is to understand where exactly have we gone wrong and then initiate corrective action. Corrective action could be of two types. A, there is some problem with the way things have happened. So there is a problem with the existing process and you have to work towards finding out the reasons and removing those inefficiencies. The second solution to this could be maybe your budgeted numbers are wrong. Maybe your budgeting was off the mark, and then you might have to go and revise the budget for next year instead of using these numbers as the base. So there could be two kinds of corrective action as a response to this.
Oh, okay. Thank you.
You're welcome. Now let's look at what is a flexible budget. Flexible budget. So this is budget prepared at the start of the year for multiple levels of activity. ठीक है. What is flexible budget? Budget prepared at the start of the period for multiple levels of activity. So what we'll do is, what the business entity will do is they will particulars Then for 1,000 books, for 1,500 books, for 2,000 books. So maybe they will make it for three different levels of activity in the entity. For 1,000, for 1,500, for 2,000. 1,000, 1,500, 2,000. So for 1,000, you already have it. What they will do is this is made at the start of the year. Okay, the difference between adjusted fixed budget and other budgets is adjusted fixed budget or flexed budget is basically made at the end of the year so as to enable the right variance analysis. Okay, so this into 80 into 75 into 30. Now, if a budget is prepared for multiple levels of activity at the beginning of the year, it is known as a flexible budget. So there are three columns that you have made. This is the flexible budget prepared at the start of the year. Even the fixed budget is prepared at the start of the year. It is only the adjusted fixed budget or the flexed budget which is prepared at the end of the year so as to enable the right kind of comparison. Okay, so till now we have looked at three concepts: fixed budget, flexible budget, and flexed budget. Another word for flexed budget is adjusted fixed budget. Let's have a look at one question. Using a flexible budgeting approach, prepare a table showing the original fixed budget, the flexed budget, the actual results, and the total meaningful variances. A business has prepared the following standard cost card on producing and selling 10,000 units per month. Selling price, variable production cost, fixed production cost. Actual production and sales for month 1 were 12,000 units, and this resulted in the following. Sales 1,25,000. These are in dollar thousand. Variable production cost 40,000. Fixed production cost 9,000. Total profit is given to you. Using a flexible budgeting approach, prepare a table showing the original fixed budget, the flexed budget, and the total meaningful variances. Now I'll give you 2 minutes. Okay, I'll give you 2 minutes to do this calculation, preparing the original fixed budget, the flexed or the adjusted fixed budget, and then we'll have to regroup and do the variance analysis. Okay, so it's I'll give you 2 minutes. Okay, start calculations, then we'll do it together. Let's see how to prepare the original fixed budget and the flexed budget. So particulars, original fixed budget 10,000, flexed budget 12,000, 12,000, actual numbers 12,000, and then variances. The comparison will be effective only if it is like for like. If you compare two things that are not similar to each other, then the entire variance analysis doesn't make any sense. It has to be for the same set of numbers basically. So, particulars, let's write down the number of units. Number of units, sales, variable production cost, then fixed production cost, and we'll also have our total profit. 10,000. Sales is standard cost card. As per the standard cost card, it is 10 per unit selling price. So this into 10. Variable production cost is 3 and fixed cost is 1. This is 3. This is 1. Now we have to calculate it for the 12,000 level of activity. So 12,000 flexed budget. What is flexed budget? Flexed budget means adjusted fixed budget. Flexed budget means adjusted fixed budget. This is budget adjusted to 12,000 units. Okay. So this is going to be again 12,000 into 10, 12,000 into 3, but your fixed production cost will remain 10,000. Why? Because fixed cost does not change according to the level of output. I'll just put a note here. Fixed production cost under flexed budget will remain 10,000 as fixed cost does not change with level of output. Now let's see what the actual numbers are. Sales 1,25,000. Variable production cost 40,000. Budgeted fixed cost was 10,000. Actual fixed cost is 9,000. Okay. So this difference is actually a good favorable variance. We have done a better job than what we were expected to. Then we were allowed so this is favorable. Now your actual variable cost is 40,000. Your budgeted fixed cost, sorry, your budgeted variable cost is 36,000. You have spent more than what you were allowed to. So it is an adverse variance. And fixed production cost, you were allowed to spend 10,000. You ended up spending 9,000. So again, this is favorable. Now, please keep one thing in mind, that the classification of variance into into favorable or adverse does not depend upon the plus or minus sign. So never make the mistake of associating plus or minus with favorable and adverse. You will have to evaluate on a case to case basis. See here, you compared 125 with 120, 5,000 positive. If you would have done 120 minus 125, you would have gotten 5,000 negative. But positive or negative sign is not what you're supposed to look at. What you should be checking is basically what is your actual number, and have you done a better job or a worse job than the budgeted numbers. The budget given to you was make a sale possible, and the sale value should be 120, but you actually ended up achieving a sale of 1,25,000. So if you have achieved a sale of 1,25,000, you have done better than than what was expected out of you. So it is a favorable variance. Here, the actual number in case of variable production cost is more than the budgeted number. Actual number is more than the budgeted number, but this is cost. That means you have spent more than what was allowed. So that becomes an adverse variance, and the plus or minus sign is in no way indicative of favorable or adverse. You will have to think about it in a logical manner. Do not think like Do not have, that BCom approach to studying where you simply associate things with rules and you calculate it that way. Let it be a very, very logical approach. Okay, have a look at it once before we move to the next topic.
So the fixed production cost will be same for the flexible budget also, right, sir?
Yes.
Okay.
Just have a look at it before we move on to the next one. Okay, chalo. Controllability and performance management. A cost is controllable if a manager is responsible for it being incurred or is able to authorize the expenditure. A manager should only be evaluated on the costs over which they have control. Now, my job is to teach. You cannot hold me accountable for a marketing expenditure. But if I am the marketing manager and somebody is checking the amount of money spent on Insta ads or spent on Facebook ads, then naturally I will be held accountable. I will be held answerable that we had allowed you to spend 1 lakh rupees per day. You spent 1,30,000 rupees per day. Why have you spent a bigger number? So as a marketing manager, I can be held accountable for that, but as the marketing manager, I cannot be held accountable for the cost of book printing. So all of these are important elements in terms of accountability and in terms of fixating responsibility on different people in the system. A manager should only be held accountable for the costs which they can control. And to understand that, let's look at a question. The material purchasing manager is assessed on total material expenditure for the organization, the cost of introducing safety measures regarding the standard and quality of materials in accordance with the revised government legislation, a notional rental cost allocated by head office for the material storage area. Discuss whether these costs are controllable by the manager and if they should be used to appraise the manager. So, if you want to assess the performance of the manager, should you be thinking of, should you consider these costs? You have to think from the point of view of purchase manager. Okay, what is the total material expenditure for him? That he will be held responsible for the purchase cost. Purchase manager will be held responsible for the purchase cost. ठीक है. Now, purchase manager will be held responsible for purchase cost. And how is purchase cost calculated? Purchase cost is number of units purchased into rate per unit. Number of units purchased into rate per unit. Now, the material used, how much material is used in the production process, that will determine how many units are purchased. Okay, now number of units purchased will be affected by the number of units used in production process. The material used will depend upon the number of units used in production process, and that will have an impact on the number of units purchased. If the usage is more, naturally the production will also be more. Now, usage is the responsibility of the production team. Production team is responsible for ensuring the correct usage with minimum wastage. And rate per unit. This rate is negotiated by the purchasing manager, and hence the rate per unit is the responsibility of the purchase manager. He can be held accountable for the rate. How did you negotiate the correct number with the supplier? Did you negotiate the correct supply terms? For that, you can hold the purchase manager responsible. But for number of units purchased, you cannot hold him accountable, because number of units purchased depends upon how many units were used in production. And how many units were used in production is the responsibility of the production manager, not the purchase manager. Now, the total material expenditure of the organization he should not be held accountable for. Okay. So this is talking about total material expenditure. Okay. Purchase cost depends on this particular item. Now, the material used calculation is the responsibility of the production team. Production team is responsible for ensuring that you are using the appropriate quantity without causing any wastage. Rate per unit, that is what the purchase manager will negotiate, bargain with the supplier. So that part is his responsibility. And um then so he can be held accountable for the rate but not for the usage. Then the cost of introducing the safety measures regarding the standard and quality of material. Now, the purchase team and consequently the purchase manager, so it is the job of the purchase team to ensure that the material received from the supplier is of the desired standard and quality as prescribed in government legislation. Purchase manager has to keep these costs in control as per management guidelines. So, uh, basically, this is not quality of final output. This is quality of material purchased. And so it will be the responsibility of the purchase team to ensure the quality is as per the government standards for all the material purchased. Hence, the cost of introducing safety measures in this case will be the responsibility of the purchase team, and you can hold the purchase manager accountable. Hence, this is the controllable cost element. And last one, notional rental cost. This is just rent incurred in the overall organization allocated depending upon area usage. Uh, the rent is not negotiated or fixed by the purchase manager, it is fixed by the head office. And because it is fixed by the head office, it is the responsibility of it is the responsibility of head office, not of the purchase manager. Hence, again, this is not a controllable cost. Okay. So here I'm just going to make a note. Hence, not a controllable cost. I just want you to have a look at all the three explanations once. Just have a look at it once. Then we'll move to the discussion on overheads. Done?
Yes, sir.
Okay. Okay. Now, there's one important discussion that we need to do, and that is a discussion on overheads. Why is this discussion important? Because a lot of what we are going to do in activity in the first topic, that is specialist cost accounting techniques, and in all the other topics to follow, will depend on a discussion of what we discuss in overheads. Now, what are overheads? The word overhead means over something or above something. Expenditure which is incurred over and above the cost that you are incurring for material, that is the physical tangible ingredient that goes in the production process, and the human intervention or human work, which is basically your labor cost. Overheads are expenses which are incurred over and above this. Now, overheads might not always have a one-on-one nexus or a one-on-one connection with the final output. These are incurred over and above the direct expenses. And overheads are basically expenditures like in the form of rent. Now, rent is a fixed overhead because irrespective of the level of output, you still incur the same amount of rent every month. So overheads could be fixed, overheads could be variable. And in these overheads, we are going to understand a couple of concepts like allocation, apportionment, absorption, so on and so forth. Okay, let me open the sheet and we'll start. Expenses incurred which do not have a one-on-one connection. Let me change the word, or which do not have a one-on-one connection with the final output. These are over and above the direct expenses. Now, fixed overheads, example, we could think of rent, or the security guard salary. The security guard is guarding your premises. Is his job important? Yes, very, very important, because if he does not perform his job, then naturally you know material might get stolen from your premises. So, in that case, his job is important for the safety of your material. But regardless of how many units are stored in the warehouse, the salary that you pay to the security person is going to remain the same. That salary is not going to change. So, that is an example of a fixed overhead. So, rent, then uh, salary of security guard, etc. And what is variable overhead? Variable overhead is basically, uh, again, this is expenditure incurred over and above the material, labor, and other direct cost. And here, the example could be, say, for example, electricity charges, or the example could be utilities, like say for example, I'm in a kitchen and I'm running a restaurant and I'm using the LPG gas. So that LPG gas used or the water used is also an expenditure. See, the item does not enter production. It is not ingredient. It is not the raw material. Neither is it human intervention. But it is important to get the production, or it is important to get the production in motion. So these are essential costs, but they do not have a one-on-one connection with the final output. For example, electricity cost. We'll understand how the electricity cost also is distributed. Okay, variable overheads, electricity charges, water charges, etc. Now, why is electricity charge a variable overhead? The electricity bill value changes every month. Now, it is not possible for me to identify how many units of electricity were used in the production of one final unit of output. So, what I do is I take the total electricity cost, I divide it by the number of units, and I spread it over the number of units. Now, my common understanding, my basic understanding is that if I produce more units of output, naturally I will require more units of electricity. Hence, this is a variable overhead. On the other hand, even if I produce 100 units or 10,000 units or 1 lakh units, my rent of the premises that I pay, that is going to remain the same. Hence, rent is a fixed overhead. Electricity charges are a variable overhead. Okay. Now, this is the basic discussion on overheads. Now, let's look at marginal cost. Let's look at the marginal costing approach, provided you have understood this. Now, let's do a small explanation also here. Electricity charges depend on the level of output, but it is not possible to establish a one-on-one link between units produced and electricity units consumed per unit. But this cost is not fixed. It changes as output changes. So the cost is variable, but establishing a one-on-one link with final output is not possible. So electricity is a variable overhead. Okay, electricity is a variable overhead. On the other hand, let's understand how a fixed overhead works. The rent you pay for factory premises does not change whether you make 1000 units or 10,000 units or you don't make anything at all. So this is considered as your fixed overhead. Rent expense is a fixed overhead. Electricity charges are a variable overhead. Now, there are two approaches to costing, and the difference between these approaches is the treatment of fixed overheads. Okay, so just going to write down two approaches to costing. Two approaches to costing. Okay, so there are two approaches to costing, and the difference arises due to treatment of fixed overheads. If fixed overheads are included in the product cost, the approach is called absorption costing. And if fixed overheads are not included in product cost but are expensed off to P&L, the approach is called marginal costing. So marginal costing basically is considering only the variable cost as cost of making the product. So for let's understand what happens in inventory valuation. Okay. For inventory valuation, the value of inventory will be more if we use absorption costing. Naturally, because when you are using absorption costing, your total cost of producing the final output includes the fixed cost also. If you are using marginal costing, it only includes the variable cost. The marginal production cost is the cost of one unit of product or service which would be avoided if that unit were not produced, or which would increase if one extra unit were produced. Now, say for example, you have produced 15 units and now you want to produce the 16th unit. When you want to produce the 16th unit, you are not going to incur any more fixed cost. You are not going to incur any more rent, but you will incur extra material cost, extra labor cost, extra direct expenses. Maybe you will also consume more electricity. So marginal production cost is basically your variable cost. The marginal cost of a unit of inventory is the total of the variable costs required to produce the unit. This includes direct material, direct labor, direct expenses, and variable production overheads. No fixed overheads are included in inventory valuation. The fixed overheads are straight away transferred to P&L. Say our classroom rent is 4 lakh per month. Till yesterday, 50 students were attending, and now we have one more admission. Do we incur any additional rent to service one more student? No. So, any fixed cost is not a marginal cost. Marginal means how much more are you incurring? Just 1 second, guys. Just 1 second. But when I get one new student, I will have to incur the cost of printing the book. I will have to incur the cost of courier. I will have to probably incur the cost of, enrolling him on the LMS. And these are my marginal cost. So marginal cost is all the variable cost ka total. When I calculate the cost of inventory under this approach, I include all the variable cost in inventory valuation, but fixed costs are not added to inventory, they are transferred to profit and loss. Marginal cost is basically to make one more unit, how much additional cost do I have to incur? That is what I mean by marginal cost. To make one more unit, how much additional cost do I incur? Now, contribution is a term that we are going to study a little later, not right now. Marginal costing presents the following advantages. Contribution per unit is constant, unlike profit per unit, which changes with changes in sales volume. There is no under or over absorption of overheads. and hence no adjustment is required to the statement of profit or loss. Fixed costs are a period cost and are charged in full to the period under consideration. Marginal costing is useful in decision making process. It is simple to operate. Now, most of these terms we have not studied so far. We have not studied what is the meaning of contribution. We have, I'll just write down the formula for your reference, that contribution is sales minus variable cost. We'll study the concept in detail, but in some time, not immediately. Uh, let's let the thought marinate properly and then we'll go to understanding all of these points in detail. Right now, the only thing you need to keep in mind is marginal cost is basically all the variable costs taken together. What do you mean by under or over absorption of overheads? All of these points we are going to study later, not right now. Okay. Later as in maybe in the next class, or let's see if if uh, our understanding of concepts takes us to that level today only. Okay. Now, let's have a look at one question. Selling price will not be depends on what. Acha, one very important thing. I have not explained the meaning of the word contribution yet. I will explain it in some time, not right now. Now, direct material, Biscoff Limited makes only one product, the cost card of which is direct material, labor, variable production overheads, fixed production overheads, and variable selling cost, not selling price, selling cost. The selling price of one unit is 25. Budgeted fixed overheads are based on the budgeted production of 5,000 units. Sales during the period were 3,000 and the actual fixed production overheads incurred were 25,000. Calculate the total contribution earned during the period. Calculate the total profit or loss for the period. Okay. So simple calculation hai. They have asked you calculate the calculate the contribution per unit and then get the uh, total profit or loss for the period. Now, what is contribution? Contribution is sales minus variable cost. And what is profit per unit? Profit per unit is sales minus variable cost minus fixed cost. But we don't want profit per unit. We want the total profit. Sales minus variable cost minus fixed cost gives me my total profit. Okay, so let's look at all the variable cost. Let's mark out here whether it is variable or not. Material cost is variable, direct cost is variable, variable production overheads is a variable cost, fixed cost is fixed as the name suggests, and variable selling cost is also another variable cost. So if I have to calculate contribution per unit, it is 25 minus 3 minus 6 minus 2 minus 5. 25 minus, what will the answer be? Nine. The contribution per unit is 9 per unit. So, what is the total contribution? How many units did you actually produce? How many units did you actually sell? 3,000 units into 9 per unit. That is 27,000 is my total contribution. Now calculate the total profit as well. So let's see if we can calculate the total profit. Now, total profit is contribution minus the fixed cost. Here, the fixed production overheads incurred were 25,000. So, if I have to calculate my total profit, it will be 27,000. Sales minus variable cost we have already done, minus fixed cost of 25,000, that is 2,000. So this is how I get my total profit. This is how I get my contribution. Now, let's understand the meaning of the word allocation and absorption. In marginal costing, the approach was basically to consider all the variable cost as product cost. Product cost means add the amount incurred to add the amount. Product cost means to add the amount incurred to the cost of inventory. And period cost means straight away not adding it to the individual item. Okay. Period cost means not adding it to the individual item, but expensing it off to P&L. Okay. So period cost means not adding it to the individual item, but rather expensing it off to your profit and loss account. That is the marginal costing approach. Fixed overheads are again crucial for production, but they are not incurred in direct proportion to production. And we saw rent of factory as one of the example. Okay. Let's talk about necessary to do that. Now let's talk about your PM class. Okay. For your PM class, the book printing cost is a direct material cost. If there are 4 students, I have to print 4 books. Faculty, that is Satyamed, is direct labor. And the LMS cost per student is again a variable overhead. Okay, this varies according to the number of students enrolled. Now there is one student mentor who does work only for this PM batch. Okay, this person does not do any other activity. He has a fixed salary of 20,000 per month. Although this is a fixed overhead, this cost can be directly and uniquely attributed to this batch. When I assign the cost of 20,000 to this batch, I am allocating overhead. Why allocating? Because this is directly connected with this batch only. Think about a career counselor who basically gives advice to students. He does not directly participate in the coaching, so he is not direct labor. He is giving career advice to students, so it is not a direct cost. If students go to him for career advice, then he will give career advice. Okay, he gives advice to 4 batches in total. Okay, his salary is 80,000. So when you distribute this cost over 4 batches, that is known as apportionment of overheads. When you distribute the fixed cost over 4 batches, it is known as apportionment of overheads. One way to distribute the cost would be to divide 80,000 by 4 and add 20,000 to each batch cost. But this would be wrong, as number of students in each batch is different. Time spent for servicing the students is different. So that way, one way is a very simple way, but it is not the most appropriate way. If you divide 80,000 by 4 and you arrive at 20,000, that's not the correct. It is distribution of cost, but it is not the most appropriate distribution of cost. Another way would be to distribute the cost on the basis of number of students. So BT batch has 30 students, MA batch has 40 students, FA batch has 60 students, and Law batch has 70 students. The total cost incurred is 80,000. Now, this career counselor is servicing 4 batches. So One way of doing that was 80,000 by 4, but that was not very, very appropriate. Why? Because the number of students in each batch is different. So time spent with the students of each batch naturally will be different. So how are overheads apportioned? You do 80,000 into, you have to distribute it, right? Distribute it in the ratio of number of students per batch. 80,000 into 30 upon 200, then 80,000 into 40 upon 200, then 80,000 into 60 upon 200, and 80,000 into 70 upon 200. This is your total amount of 28,000. So what you did was you distributed the total amount of 80,000 in the ratio of number of students per batch. This approach, though fine, is not a perfect approach because this it is better than this. It is better than doing 80,000 upon 4. This is better. This is fine, but it is not perfect because not every student will demand the same time from the counselor. Some students might need a 1 hour session, some will be done in 5 minutes. Somebody will come to me and say, give me a study plan. I will just give a study plan. Somebody will come and say, I need advice for my career, help me in making my CV. That student will take more time. So better approach is to consider number of hours spent in each batch and then divide the cost accordingly. This approach that we are going to study later is known as activity based costing. This is our next chapter. But right now, what you need to understand is when you are distributing the cost of, when you are distributing the total amount of overheads in the ratio of the number of students, that is, a better way of distributing the cost. Apportionment is distribution of the fixed cost incurred over the total number of students. Overhead apportionment is distribution of the total cost over, apportionment is self distribution over the total base. It could be 4 batches, 5 batches, 10 batches. And the more, the better base you use, the better is the cost apportionment. Apportionment is simply division and distribution. I'll write it down here. Apportionment of overheads is simply distributing the cost over a number of, distributing the cost over units. You are not, what you are doing is you have the total cost, you are distributing it, you are spreading it out. Spreading it out over different units is apportionment. Allocation was, you are not spreading it out. You know that this one student mentor was exclusively working for this batch only, so his entire cost gets allocated to that batch. Okay, his entire cost gets allocated to that batch. That is allocation of overheads. So just have a look at allocation and apportionment once and see if you can notice the difference between the two. Read the apportionment part. Now, let's understand the concept of, we understood what is allocation and we understood what is apportionment. Now, the basis for distribution of cost is the basis of apportionment. Say, for example, there are four classes being conducted in this premises, and the total rent of the premises is, total rent of premises is 1 lakh. Okay. Now, classroom 1, classroom 2, classroom 3, and classroom 4. There are four classrooms. Okay. And classroom square foot area. This has a square foot area of 200, 250, 350, and 200. Okay, this is my overall square foot area. Now what I have to do is, in apportionment, I am distributing the cost. Apportionment means to distribute the cost over the, is to distribute the cost over the units. Okay, so total cost or total rent cost is 1 lakh, and the most appropriate way to distribute costs will be on the basis of square foot area of classroom, because rent is the amount that you pay for using the space. So the basis of apportionment should be the space that you are occupying. Okay, so when I'm going to apportion or apportioned amount, I'll write the amount here and I'll show the calculation here so that you have full base, full understanding. So this will be, you are distributing 1 lakh into, what is the square foot area? 200 upon, let's take the total of the square foot area. The total is 1000. So 1 lakh into 200 upon 1000. Then 1 lakh into 250 upon 1000. Then 1 lakh into 350 upon 1000. And again 1 lakh into 200 upon 1000. This will be how much? 20,000, 25,000, 35,000, and another 20,000. This is my total calculation. So this activity that I did is known as apportionment of overheads. The apportionment of overheads was done on the basis of the square foot area. which was the most logical way of doing it. This process is known as apportionment of overheads. Okay, now allocation was directly charging overheads to specific cost centers. If the overheads relate to more than one cost center, then you distribute it amongst them, you spread it over them. That process is known as apportionment of overheads. Okay, and there is one more concept which is again connected with overheads only, that is known as absorption of overheads. Okay, absorption of overheads is the process of now absorbing means, see, when I say that this sponge absorbs water, what it means is the water gets soaked into the sponge, it enters that sponge. When I say I want to absorb overheads, what I am doing is if I am taking the overhead cost and now I am adding it to the cost of the product, that process is known as absorption of overheads. What is absorption of overheads? Taking the indirect cost and including that in the cost of the product is known as absorption of overheads. So after absorption of overheads, this is the process of including the overhead cost incurred into the cost of product or service. So absorption happens after we have done the allocation or apportionment. Now let's understand allocation, apportionment, and absorption. How are these three things done? Okay. Now, let's look at a simple example. Okay. Now, Ishan produces 10,000 units of chocolates in a month. Okay, Ishan produces 10,000 units of chocolates in a month. The costs are cocoa, which is material, milk, which is material, and sugar, which is material. These are the costs per unit. Okay, then labor cost and packing cost. This is variable overhead. Okay, packing cost is not material that goes into production. It is used for packaging the material. 20, 10, 10, 15, 5. Okay. So total variable cost is 20 plus 10, 30 plus 10, 40, 40 plus 20, 60. Now, the rent of machine which was used to produce chocolates was 25,000. Was 25,000 nahi chalo, was 24,000 per annum. We want to include the machine cost, or we want to include the machine rent in overall production cost. Okay, we want to include the machine rent in overall production cost. So how will we do that? 24,000 upon 12 gives me 2000 per month as machine rent. Okay, now my normal production level is also 10,000 units. So machine rent per month is 2000, sorry, not per month, machine rent per unit produced is 2000 upon 10,000 is 0.20 per unit. And now, what is the total cost? Total cost is 16 plus 0.20, that is 60.20. With this step, we have absorbed the cost in, we have absorbed the fixed overhead in product cost. Let's say the way a sponge absorbs water, here the cost was absorbed in the total cost. This process is known as absorption of overheads. Now, the way this is calculated, this calculation that you did here, for this, you will have to understand the overhead absorption rate. ठीक है, overhead absorption rate is basically budgeted overhead upon budgeted output. Okay. Overhead absorption rate is budgeted overhead upon budgeted output. ठीक है? Are you all with me?
Sir.
Okay. So let's keep this as the base now. Has everyone understood what is absorption of overhead?
Yes, sir.
Now, there is one more concept that is going to be very important, that is under absorption or over absorption of overheads, but that's a discussion for slightly later. We'll stop here today. Just I need to ask you a couple of questions.